The 2008 global financial crisis was a significant event that had far-reaching economic consequences for countries worldwide. It was the most severe economic downturn since the Great Depression of the 1930s, and it led to widespread job losses, reduced economic output, and significant public and private debt. The crisis started in the United States in 2007 and quickly spread across the world, affecting many different industries and economies. One of the primary causes was the housing market bubble in the United States. Between 2000 and 2006, housing prices in the United States increased by more than 80%, driven by easy access to credit, low interest rates, and speculation. Banks and other financial institutions created complex financial instruments such as mortgage-backed securities, which were sold to investors around the world. As the housing market bubble grew, banks and other financial institutions became increasingly leveraged, meaning they borrowed more and more money to invest in the housing market. Another significant factor that contributed to the crisis was the deregulation of the financial industry in the United States. The Glass-Steagall Act, also known as the Banking Act of 1933, was a law passed by the United States Congress in response to the Great Depression. It established a separation between commercial banks, which take deposits and make loans to individuals and businesses, and investment banks, which facilitate the buying and selling of securities and provide other financial services. The law aimed to prevent conflicts of interest, reduce risk, and protect consumers by limiting the activities of banks and other financial institutions. In 1999, the Glass-Steagall Act was repealed, which had separated commercial and investment banking since the Great Depression. This allowed banks to engage in riskier activities such as investing in mortgage-backed securities and derivatives. The lack of oversight and regulation allowed financial institutions to take on excessive risk and engage in fraudulent behavior, leading to the collapse of several major financial institutions, including Lehman Brothers. The crisis led to a severe recession in many countries, resulting in high unemployment rates and reduced economic output. Many businesses were forced to close, and others had to significantly reduce their operations. The housing market in the United States collapsed, leading to widespread foreclosures and evictions. The crisis also had significant impacts on global trade, with many countries experiencing a reduction in exports and imports. The crisis also had a significant impact on public and private debt. Many governments around the world had to borrow significant amounts of money to stimulate their economies, leading to a substantial increase in public debt. Private debt also increased as many individuals and businesses were unable to repay their loans, leading to defaults and bankruptcies. The role of government in the 2008 global financial crisis has been a subject of debate. Some argue that government policies, such as deregulation and lax oversight, contributed to the crisis. Others argue that the government's response to the crisis was inadequate, and more aggressive action was needed to prevent the crisis from becoming worse. One government response to the crisis was the Troubled Asset Relief Program, TARP, which was passed by the United States Congress in 2008. The program authorized the Treasury Department to purchase troubled assets from banks and other financial institutions, with the goal of stabilizing the financial system. The program referred to in this statement is likely the Troubled Asset Relief Program, TARP, which was a U.S. government program created in 2008 to purchase troubled assets from banks and other financial institutions. TARP was intended to stabilize the financial system and prevent a collapse of the banking sector during the 2008 global financial crisis. However, the program was controversial for several reasons. One major criticism was that it rewarded irresponsible behavior by banks and financial institutions that had engaged in risky lending practices and other questionable activities. Some argued that by bailing out these institutions, the government was effectively encouraging them to continue engaging in risky behavior in the future. Another criticism was that TARP was not distributed fairly, with some institutions receiving more help than others. There were also concerns about the lack of oversight and transparency in the program, with some questioning whether the funds were being used appropriately. The Federal Reserve also played a significant role in responding to the crisis. The Federal Reserve lowered interest rates to near zero and implemented several rounds of quantitative easing, which involved purchasing large amounts of government bonds and other securities. The 2008 global financial crisis had significant impacts on public and private debt levels in many countries. Public debt refers to the amount of money that a government owes to lenders, such as other governments, financial institutions, or individuals. Private debt, on the other hand, refers to the amount of money that individuals or businesses owe to lenders. Following the crisis, many governments around the world had to borrow significant amounts of money to stimulate their economies and prevent further damage. As a result, public debt levels increased substantially in many countries. For example, in the United States, public debt increased from $9.2 trillion in 2007 to $14 trillion in 2010, an increase of nearly 52%. Similarly, in the United Kingdom, public debt increased from 44% of GDP in 2007 to 89% of GDP in 2010. In addition to the increase in public debt, private debt levels also increased in many countries. This was due to the widespread defaults and bankruptcies that occurred during the crisis, as well as the decline in housing prices. In the United States, for example, household debt increased from $12.7 trillion in 2007 to $13.9 trillion in 2008. Similarly, in Spain, household debt increased from 85% of GDP in 2000 to 120% of GDP in 2009. The increase in public and private debt levels had several consequences. One of the most significant consequences was the burden it placed on future generations. As governments borrowed more money to stimulate their economies, they also increased the amount of debt that future generations would have to pay off. This could lead to higher taxes, reduced government services, and decreased economic growth in the long term. Another consequence of the increase in public and private debt was the risk of a sovereign debt crisis. A sovereign debt crisis occurs when a government is unable to repay its debts, which can lead to a default on its obligations. During the 2008 global financial crisis, several countries, such as Greece and Ireland, experienced sovereign debt crises, which had far-reaching economic consequences. The 2008 global financial crisis had significant impacts on public and private debt levels in many countries. The increase in debt levels had several consequences, including the burden it placed on future generations and the risk of a sovereign debt crisis. As countries continue to recover from the crisis, it is essential to address these debt levels to ensure long-term economic stability and growth. The increase in public and private debt levels following the 2008 global financial crisis has significant implications for future generations. As governments borrowed more money to stimulate their economies and prevent further damage, they effectively increased the amount of debt that future generations would have to pay off. One possibility is that future generations may have to pay higher taxes to service the debt. Furthermore, the increase in public and private debt levels could have implications for global economic stability. If countries continue to borrow excessively, they may become vulnerable to a sovereign debt crisis, which could have far-reaching consequences for the global economy. In short, the increase in public and private debt levels following the 2008 global financial crisis has significant implications for future generations. It could lead to higher taxes, reduced government services, and decreased economic growth, and could also contribute to broader economic instability. As such, it is important for policymakers to address these debt levels and work towards a more sustainable and stable economic future. Please consult a financial professional before making any financial decisions.